What's up, everybody? This is Alex Sylvia from NuView Trust Company. Just want to give you a welcome to this week's virtual workshop covering right time, right place, right deal. I won't be presenting today, but I will be taking questions. Nate here will still be doing the presentation today, but I'm kicking things off, giving a little bit of an introduction and also introducing our sponsor. This is Minion May. He is from Passive Cash Flow for Life, also Virtual REI. They do online real estate education for new investors, and he's got a few slides that he's going to be sharing today. You know, see if there's some value that their educational programs could provide to you, the real estate investor. So without further ado, this is Minion May from Passive Cash Flow for Life and Virtual REI.
Thank you. How's everybody doing today? I hope everyone is doing well. I kind of got caught off guard to do this, but I had to cover for one of my teammates, and I only say that to say this: we work as a team. And real estate, you need people on your team. So we have a company called Passive Cash Flow for Life, which has two educational companies up under it. Okay. I'm a full-time real estate investor. I'm sitting in my home office. This is what I do all day, every day. I've been in the business for a few years, and I do a lot of creative strategies and things like that we also teach all of our students and members of our educational platforms. So we have our online education for real estate investors. As I said, that's Passive Cash Flow for Life. Next, we have the Virtual REI Academy. Now, Virtual REI Academy focuses on residential real estate investing, such as rentals, wholesaling, rehabbing houses, various avenues of real estate where you are a transactional engineer, as we like to call it. The misconception people have about real estate is that you must own everything to make money. No, you need to control as much as you can to make money now and have passive cash flow coming in the future. I myself do a lot of creative strategies with owner financing, things like that, and I don't have to deal with the bank so much. And I have a very high return on many of my rental properties because of creative financing and really finding a good deal. So some of the strategies within real estate help each other. The passive cash flow for life is actually called multifamily passive cash flow for life. This would be anything 5 units and above. It's also classified as commercial. So in this educational side of the company, we deal with storage units, mobile home parks, apartment buildings, 5 and up, as well as 100 plus in mobile homes and apartment buildings. So that's the commercial side of it, or the multifamily side of it. And we actually refer to it as doors or units. You can find us at meetup.com for our monthly meetup, live and on Facebook. So we have Virtual REI Academy and we have multifamily passive cash flow. You can just go into meetup.com. You can find both of those. We also have both of those in Facebook groups. So if you go into Facebook and you look up Virtual REI Academy, just right here, or you look up Passive Cash Flow for Life, Multifamily Passive Cash Flow for Life, you will find us there. And we have a student member group, and then we have a group that's free to the public. And we are also this week doing a live masterclass. So this is myself, Kathy Corley, and Nicole Amundsen. Nicole owns or holds over 5,800 doors in commercial real estate. She's been in the business for over 25 years. Kathy and I, we've been in the real estate business for quite some time, and both of us are very active in multiple markets. All up and down the East Coast. So this is going on right now. You can Google this or look us up. We'll give the link on the next slide. You feel free to join us. We are in the middle of the single family residential side right now. And this weekend, we will be doing the commercial side from 12 to 4:30 on Saturday and Sunday. And trust me, you will learn a lot. Yours truly is teaching this week, and I think I'll also be teaching on Saturday as well. So for more information on that, oh, well, I skipped something. So also with your subscription, if you decide to take the online course, you get these things right here, such as faculty who work with their topic area of expertise. We also have coaching 101. We have biweekly Zoom Q&A in both groups. So that's actually one a week. Quarterly newsletter, daily social media postings, and monthly subscriber calls. And how to subscribe? Just click the link down here at the bottom of the slide and you can find more about us. And trust me, if you've ever thought about getting into real estate, now is the time.
Thank you, Minion. Hey, can you do me a favor? Can you
Yes,
also print that or type that link in the chat? So if anybody wants to click on it, I'm not sure if they can click on the screen, but if you want to type it into the chat, that'd be amazing.
I'll put that into the chat here shortly.
Yeah, and I appreciate your time. So thank you again. Please reach out to them. I know Kathy personally does a lot of stuff with her group. They share a lot of NuView information as well when it comes to education. So they're big on education, and they're big on self-directed IRA. So we appreciate them and all that they do. Let's jump right into it. My name is Nate Hare. I'm the Director of Sales at NuView Trust Company. I am a certified IRA services professional. If you are here for the first time, what does that nerdy term mean? It just means that I know a lot about retirement accounts and IRAs in general, but more specifically about self-directed IRAs, which we're going to talk about today. And we're going to do it in a little bit different fashion than we normally do it. I'm going to do it talking about specific types of plans in relation to specific types of investments. And this is where it gets really cool and interesting in the self-directed IRA space, because you have these different types of accounts that are administrated here at NuView Trust Company that have different tax benefits to them. And you as an investor or a fiduciary of those accounts that you set up can pick and choose the investments that each of these plans invest in. And because of the tax benefits and because of the differences of how these plans work, sometimes different investments fit better in different plans. But often people just don't have time to stop and think about it. So we're going to stop and think about it today and talk about what's the right time, the right place, and the right deals for my self-directed IRA. So let's just jump right into it. First, let's just talk about what is a self-directed IRA for anybody who is new. If you're hearing this term for the first time, don't get confused with self-directed. It's just a marketing term. When we're talking about IRAs, we're just talking about an individual retirement account. An individual retirement account at Fidelity is no different legally than an individual retirement account at NuView. The only difference is what us as companies do and what types of investments we hold. Your Fidelities and Charles Schwabs of the world holds traditional investments, stocks, bonds, mutual funds, and CDs. But an IRA can invest into all sorts of things outside of those traditional investments. But when you want to invest in what we call alternative investments or non-traditional investments, you have to have an account or an IRA set up with a company like NuView. And what an IRA at NuView allows you to do is invest in everything outside of the stock market and things like real estate, private stock, investments into private companies, promissory notes secured by real estate. The list goes on and on. I'll kind of touch on the different types of investment opportunities that are available to us out there. But as a general rule of thumb, an IRA can own anything. You just have to find a company willing to administrate the assets you wish to hold. So don't get confused with the term self-directed. It's just a marketing term. Our clients at NuView have IRAs all over the place. Their NuView IRA holds their alternative assets, and their Fidelity or Charles Schwab IRAs hold their traditional assets. Why would someone want a self-directed IRA? What's the purpose of one? Well, first, it allows you true diversification. It allows you to invest in all sorts of things. We have clients, and they probably don't want me telling you this, but we have clients that have NuView accounts that work at Charles Schwab. They work at Fidelity. What's the reason they would have a self-directed IRA? Because they can't hold real estate in a Charles Schwab IRA. They can't hold investments into private stock in a Charles Schwab IRA. So if you really want to diversify and give yourself as the investor the broadest spectrum of investment options, have an IRA that allows you to invest in alternative assets. That gives you real diversification. But when you're talking about IRAs and even HSAs, which we'll talk about today, and we'll even talk about the ESA, the Education Savings Account, all of these accounts that we have here at NuView all give you tax savings. They give you specialized tax shelter that you don't get as an individual. So if you can understand these plans and you have these plans set up not only for yourself, but for your spouse, for your kids, for your grandkids, you have the opportunity to grow investments in a completely tax sheltered environment. Whether that tax sheltered environment allows you to buy and sell the investments completely tax deferred, or whether that tax sheltered environment allows you to invest completely tax free. That's the biggest benefit to an individual retirement account, a health savings account, an education savings account, a 401k, the list goes on and on. The tax savings is where the true magic happens when it comes to your investments. But what a self-directed IRA also allows you to do is invest in what you know best. We talk to investors of all sorts, and a lot of the investors that we deal with at NuView are either note investors or they're syndication investors. They invest into private stock or startup companies. They have a knowledge base that extends outside of the stock market. And for them to apply their knowledge as an investor to help grow their retirement, that's where the self-directed IRA comes into place and helps those investors that have specialized knowledge. So what are the benefits of self-direction? True diversification, tax savings, and they allow you to invest in what you know best. What are the types of plans that can be self-directed? And then I'll talk about the types of investments you can hold within them. And then we got a couple different case studies on how clients took specific accounts, applied it to specific investments for certain reasons that gave them true power when it comes to these types of self-directed plans. Most people are familiar with your self-directed personal plans, which would include your traditional IRA and your Roth IRA. Anybody can have a traditional IRA and Roth IRA. Most people have them. You might have started with a 401k at a job that you worked at. You might have been putting money in there out of your check. Your employer might have been matching. Typically, those are pre-taxed accounts. And when you leave that job, those pre-taxed 401ks or pre-tax 403bs typically roll into a pre-tax IRA, which would be a traditional IRA. But you can also self-direct a Roth IRA, which is just an after-tax account. Both accounts can be self-directed. Both accounts are great for tax savings. We have classes that talk about the differences of the two. I'm not going to spend too much time on those. Most people understand the differences, but either one can be self-directed or self-directed together if you have multiple accounts. A lot of our clients have traditional IRAs and Roth IRAs that they group together to make investments into alternative assets. If you're self-employed, you also have additional options that you can use for tax shelter and for self-direction. Those would include your SEP IRAs, your simple IRAs, or even your own individual 401k. Some people call it a QRP, some people will call it a 401k. And the 401k or QRP that we have here at NuView also has a Roth component to it. It's a tremendous vehicle for those of you who are trying to stash more money away from Uncle Sam that he can't touch. These plans allow for the largest contributions you can make on an annual basis. So money you take out of your pocket and add each year. If you're self-employed, you can add more money to these plans than you can any other plan. But don't get contribution confused with profit. I will tell you, profit is unlimited. So when it comes to contributions, contribute to the plans you qualify for, contribute to the plans that give you tax deductions if you need tax deductions, but contribute to all the plans that give you tax shelter, whether it's personal plans, employer plans, and the specialty plans we'll go over. The important part is you should have plans on each page of the menu if you qualify for them. That's how you really maximize the tax savings when it comes to your investment growth. And then these plans I want to talk about specifically today because they're one of the most overlooked plans, but two of the most powerful plans if you use them appropriately. And that would be your health savings accounts and your education savings accounts, which would be the Coverdell education savings accounts that you can set up for your kids or your grandkids. And what I'm going to do in these first two case studies is show you actual investments made by actual clients in these accounts. And then also with that, talk about what you can do with that investment profit, why it's a special benefit in a health savings account and an education savings account, because these are not retirement accounts. Okay, these are different. They can still be self-directed. You can still create tax-free wealth. But the benefit to these plans specifically is that they can help fund education expenses for your kids and grandkids with completely tax-free dollars, and pay for out-of-pocket health expenses for yourself, your spouse, and all of your dependents. Okay, for any out-of-pocket health expenses, again, with tax-free dollars. These plans specifically help you pay for things today, where your IRAs are more for paying things in retirement. So let's jump in right into it and just talk about first the investment options. If you're not familiar with self-directed IRAs, what do they allow you to invest in? Well, all sorts of things. Actually, hold on one sec. I'm skipping too far. Real estate, for example, that's supposed to be fee simple real estate, mortgage notes, apartments, investments into things like real estate options, syndications, unimproved land, commercial property, the list goes on and on. The IRS actually doesn't tell us what we are allowed to invest in with our IRAs. They only tell us what we are not allowed to invest in with our IRAs. And the list is really short. It's only two things not allowed in your IRAs, HSAs, and ESAs: life insurance contracts and collectibles. That's it. Anything else is fair game. So let's take a look at some investment case studies from actual clients. And we're going to look at the first one, which is a client that used a Coverdell education savings account to use when they found an investment, but did it in a way to where they can create tax-free income to help pay for their child's education expenses. So we had a client named Jonathan. Okay, Jonathan is a real estate investor here in Florida, and Jonathan had a good deal. Okay, he found a property that was below market value. Okay, through his mailers, through his yellow cards, all the things that you real estate investors do. He found a property that was inherited by a person that lived out of state. Okay, this property was abandoned. It was in decent shape, but the person that ended up owning it didn't really want anything to do with it. But they struck up a pretty good deal, and Jonathan figured, there's a lot of equity in this property. I can do something with this. Now, what do you do with a property with a lot of equity? You could keep it as a rental, you could flip it. And some people actually wholesale properties that they find under market value. The other part of this story, though, is that Jonathan has a 9-year-old son, Alex. Okay, and Alex goes to private school. And private school, for most of you who know this, is pretty expensive. Okay, about $12,000 a year is what it costs the average American family to put one child through private school. And that doesn't include uniforms, books, all the other things that you got to pay for. But we're just talking tuition. So what Jonathan is trying to evaluate here as a real estate investor is he's trying to evaluate what's the best use of his money. Okay? He could very easily do this investment through his LLC, which is just a pass-through entity when it comes to taxation, and the taxation passes back through to him, the individual taxpayer. Now, Alex is a pretty good real estate investor, and he's in a pretty high tax bracket. Okay, we'll call it 35%. So Alex thinks, you know what, if I can just get this property under contract, I got a buyer's list. I can wholesale this contract to another investor and probably easily $25,000. But when it comes to the end of the year, that $25,000 of additional income is going to create Jonathan $8,700 in additional taxes. Now, the whole purpose of this investment, or really a lot of his investments, is he's putting his son through school. Now, there's the investments that he has that help put food on the table, but one of the biggest expenses that he has each year is putting his son, Alex, through private school. So what he did is he was watching some classes on NuView at NuView, and he had heard about the Coverdell Education Savings Account. He called an IRA specialist and said, you know what, all I really need for this investment is just enough to put an earnest money down, and I think that I can wholesale this contract to another investor, but I want to do it in a smarter way. So what Jonathan ended up doing is he decided to open a Coverdell Education Savings Account for his son, Alex. His son, Alex, is the designated beneficiary of this account. And here's how the Coverdell works. The responsible individual or the parent can open the account for the child. The benefit to the account is to any of the child's qualified education expenses. Here's the key. Here's the cool part with the education savings account. The responsible individual opens the account, but anybody can be the depositor. Hint, hint, grandparents. A lot of grandparents like to open up Coverdell education savings accounts for their kids, especially if the grandparents are familiar with investing. So we have a lot of grandparents that end up opening the account for the child or their grandchild. The responsible individual still fills out the application. The grandparent is the depositor, and the grandparent can invest the funds. But remember, all of the investment activity, all of the profit will come back to the Coverdell education account, and that profit can be used to pay for qualified education expenses for that child, tax-free and penalty-free. So in this case, Jonathan was just doing this all on his own. So he opens the account, doesn't cost anything to open the account, and then he makes a contribution to the account of $500 because that's all he needed in this investment as far as the earnest money went. So what Jonathan is ultimately doing is just doing all the same legwork he would have done had he done this investment in his LLC. It's just now the contract, the buyer is not his LLC. On the contract, the buyer is NuView Trust Company. That's us. FBO stands for the benefit of, his son's name, and his ESA account number. The $500 contribution that he made to the account is what NuView uses to send as earnest money to the title company. And then we also sign off as the buyer. So all he's doing is using NuView as the intermediary because we're using the child's Coverdell education account, and everything is titled in the name of the ESA from beginning to end. 3 weeks later, he found an end buyer that the contract was wholesaled to, and he made a wholesale fee of $25,000. But remember, the contract and all the money came from the Coverdell education savings account. So at closing, the $25,000 wholesale fee doesn't go to Jonathan, it goes to the Coverdell education savings account. So by doing this investment, making the same amount of profit he would have, but using the ESA instead of the LLC, Jonathan was able to bypass any taxation and pay for 2 years of tuition for his son, Alex, instead of approximately 1 year. Same investment, same profit, different bucket. Okay. He used his knowledge as an investor to create tax-free income that can pay for his son's education expenses going forward. Now, I'll give you some more fun facts on this education savings account in a second here. I will make one caution to you guys. Be careful with wholesaling as a strategy. There's nothing specifically saying wholesaling is prohibited or anything like that. But it can be perceived as an extension of service if you're a real estate investor. Now, there's not much case law on this. I will tell you it's just a caution. An alternative to doing wholesaling, I would say, would be a real estate option. Jonathan could have used an option contract instead of just a normal contract where you're just flipping the contract. That would be an option, a real estate option, pardon the pun. But I just want to give a little bit of caution there. Be careful on doing too much wholesaling because it could be perceived as you extending a service to the ESA and not actually doing an investment. Okay, so moving on, let's talk about the ESA and talk about how it works and then how the distributions work and where Jonathan as the parent gets the true benefit. First, when you're putting money into the ESA, you have a contribution limit each year of $2,000 per child per year. Okay, so if you've got 3 children, you set up an ESA for all 3 of them. That's the limit. You don't have to put in $2,000, but that is the maximum. You could see in Jonathan's case, he only put in $500 because that's all he needed for the investment. The contribution deadline is April 15th or whatever the tax filing deadline is. So if you're looking to set up accounts for your kids and make contributions for 2021, you actually have all the way until April 15th, 2022 to make contributions for 2021. I would say get contributions in as early as you can, because if you run into an investment, at least you have the account open and set up, and just put a little bit of money in there. Put $100 in there, put $500 in there. You don't have to max it out at the beginning, but if you want to max it out for the entire year, make sure you get that full $2,000 in before April 15th. Contributions are not tax deductible. Okay. However, the investment growth within the account is completely tax-free and penalty-free, provided you use the profit to pay for qualified education expenses. Okay? And we'll talk about what qualified education expenses are here in a minute. And I mentioned this earlier on the several slides back. The responsible individual sets up the account, but anyone can be the depositor. For instance, I have ESAs for my 2 nieces because I'm the depositor. I'm the one that puts the money in there. I'm also the power of attorney, so I make the investments, but ultimately the benefit is going to go to my 2 nieces once there's profit realized, and I can give that to them to help pay for their education expenses. Now, these are education expenses that can be paid all the way from kindergarten through college. So this is not just a college savings plan. Okay. So to qualify to use the ESA funds, first, the beneficiary or the designated beneficiary, the child, must be enrolled in school. If they're in college, they must be at least half-time if they're a half-time student. Okay, they can do part-time work, but they got to be at least half-time as a student if you're going to be paying for tuition through their college and things like that. Contributions can be made up until the child's 18th birthday. So if you have a child that's older than 18, it might be too late to set up an account for them because you can't make contributions past their 18th birthday, but contributions can be made all the way up until the child's 18th birthday. Okay. But the account can be used all the way until that child reaches age 30. Okay, so all the way until that child, the designated beneficiary, reaches age 30, you can use the account, you can invest the account, you can use the distributions to pay for their qualified out-of-pocket education expenses. And if there's money left over and the child reaches age 30, you have 2 options as the responsible individual. You can just distribute what's left in the account to that child, and it's just treated as ordinary income to the child, or you can transfer the beneficial ownership of that account down to another child. And it doesn't even have to be your child. It could be your child's child at that point. The really only provision of when you pass that down to another child, that child has to be under the age of 30. So it can go out to a cousin, it can go out to a second cousin, it can go out to your child's child, as I mentioned. So you can keep the benefit of the account going down, or just pass it down to your middle child or whatever child that you still have in school that you need education expenses paid for. So it's really flexible in how you can move it down the line. What are some of the things that you can pay for as a qualified expense? Tuition, fees, books, supplies, uniforms, room and board, traveling, tutoring, computers, equipment, even home internet. If your child is living at home and you have a home internet bill, that's a qualified education expense, and all cabling. So think about what you as a parent pay for each month when it comes to your home internet bill. How much more of those bills could you pay if you didn't have to pay taxes on the income you're using to pay it? See, most parents are paying all of these expenses that you're looking at here out of their back pocket. Hip National, they pay it off of their earnings. Well, the problem with the earnings, as you saw in Jonathan's story, is had he have done that investment and made $25,000 in his LLC, he would have lost almost $9,000 just to Uncle Sam. So you're losing profit just through taxation. But if you just do the investment, the same investment in a different bucket, well, then you can consume all of these goods and not have to pay any other taxes. So ultimately you get to consume more goods. And it's really cool because the ESA, it's the only account, education savings account, that can be self-directed. And like I said earlier, you can pay for education expenses from kindergarten all the way through college. So pre-K, so kindergarten, K through 12, high school, junior high, and even vocational schools are covered, vocational schools and the equipment. And if you want more light reading on this, if you want to get a full detailed description of this, go to IRS publication 970. But really cool way to use an account. And what was the reason why he used this account for that investment? It's because the investment paid off in 3 weeks. So when you're thinking about these investments, could he have done that investment in his Roth? Sure. But with his Roth IRAs or his other retirement accounts, the benefit doesn't come until after he's 59 and a half, because there's usually early distribution penalties if you take the money out. So he wants to use the account that fits the need. The need for him was to pay for education expenses, which are today. So that's why he used the education savings account on this investment specifically, because it paid off in 3 weeks. Right time, right place, right deal. And I think he did a pretty good job matching all that up. Okay. Let's talk. And by the way, if you guys have questions, I want you to type the questions into the chat box. Alex is sitting here right here next to me, so he'll answer questions. If you have questions on specifics of the accounts, he'll address them, or we'll address them at the end. Okay. Moving on, let's talk about one of my favorite accounts, maybe my most favorite account outside of the Roth IRA. That would be the health savings account. So the health savings account is a phenomenal account. It almost works like a secondary Roth. The interesting thing that I find is that there's a lot of people that have health savings accounts. Either it was set up by their employer and they moved it over. It's sitting at Bank of America. It's sitting at Wells Fargo, but nobody invests these accounts. Maybe because they weren't told that they could, maybe they didn't know what their investment options are. But I would say 50% of the people that I run into that have a health savings account just have it set up as a savings account that's uninvested. The best thing about a health savings account, not only is it that it works like a savings account, but you can invest it and you can grow it on your terms, and it can be self-directed. So let's talk about an investor that we have named Sarah and how she did an investment with her health savings account that was, by the way, sitting parked at Bank of America doing absolutely nothing. And when she found out she can use her HSA to buy notes, the world changed for her in an instant. So Sarah's a note investor. She likes to buy existing notes, okay? And she had a good deal. Now, this deal actually came from an investor friend of hers, which is really how a lot of the self-directed investors find their deals, is by leveraging their network. I talk a lot about that on previous episodes. Leveraging your network is key to being a good self-directed IRA or self-directed HSA investor. And this investor friend of hers was in retirement. Okay, he had a lot of note. He was a note investor also himself, and he was just looking to settle down. He didn't really want to deal with following up on payments that his borrowers were making, and he had good borrowers. So he just started looking at some assets that he just wanted to liquidate. Some of these notes were almost paid off, and he just wanted to start cashing in on some of these investments and not wait for the payoff to come through the interest payments. So he started selling off some of these notes, and he offered Sarah a note, and it was going to be offered to her at below the principal note balance, which she really liked. But because she was going to be walking into a deal at an immediate discount, she didn't want to be taxed on that discount, because if she did that through her name or through her LLC, again, this is going to be investment income to her as the individual. So she had this HSA sitting making zero uninvested that she had made contributions to over many years, but just never did anything with it. So what she did is she set up an HSA here at NuView and transferred over the $20,000 she had sitting in Bank of America. Now, here's kind of the details of the note. The note was being offered to her for $18,000. And again, she could have bought this herself, or she decided to buy it with her HSA. The principal balance of the note was $24,000, but the note was secured by a property that was worth almost $300,000, and the borrower was solid. The borrower never missed a payment. The borrower was on time every month, and they even had a hint that the borrower might even pay this note off as it got closer to, where the note, it was almost, very little principal due on the note at all. The note interest was at 6% annually, and there's about 60 months or about 5 years left on the note based on the amortization schedule. So again, she's looking at this as an investor and saying, I'm going to buy this note as a discount. I've got this HSA sitting there that's got just enough to get this note purchased. Why don't I do this in my HSA? So she set up the HSA with NuView, moved the money over, and that just takes a transfer form being sent to Bank of America, and Bank of America wiring the funds over to NuView. Takes about maybe a week or two, not very long. And then what she does is she goes through the process of getting NuView all the documents they need to buy this existing note. Okay. Now, what we would need to buy an existing note is, first, we always need what's called our purchase packet. Okay. We have different purchase packets for each investment. So for a note investment, we have a note purchase packet. It's really just really basic. What's the note balance? Who's the note being bought by? Is it an existing note? Is a yada, yada, yada. It's all really self-explanatory. That is what clients fill out to give us the authority as NuView to make the investment. And then with that authority, we also need a copy of the agreement. Now, in this case, she's not creating a note, she's buying an already existing note. So we need a couple things from her. First, and these are things that she would have an attorney draft or have somebody draft. We don't draft these ourselves, but what we do as NuView is we sign as the new lender. So we always need either the assignment of lien or assignment of note, sometimes both. And if we don't have enough information on the assignments, we would also like to have the original note if possible. So in the best case scenario, she fills out the NuView purchase packet, gets us the original note and any assignments to that note and lien. Okay. NuView signs off as the new lender, and we send the purchase, which in this case was $18,000, to the note seller. Okay. And that comes directly out of her HSA. From that point, we retain all the documents here at NuView, just like Fidelity holds your stock certificates. NuView holds your notes, your assignments of liens, your assignments of notes, all the documentation that show your HSA owns this note investment. So it's really pretty clean, and we can get this done as fast as those documents can get drafted, and we can send a wire as fast as we can process this investment. So once the note is now owned in her HSA, an allonge is drafted, which shows that the payments now from the borrower are going to go to NuView instead of the old lender. Okay, so she has payments now coming in to her IRA, to her HSA, excuse me, based on that 6% interest. And the borrower, as expected, ended up paying off the balance early, and that was about 20 months into the deal. So why is that important? Well, her yield shoots up because she was expecting it to pay it off maybe in 5 years. She got paid off in just under 2 years. And remember, all of that profit that she made by buying at a discount all comes back to her HSA completely tax-free and penalty-free. She was so happy because she had never made anywhere near the money that she made on this HSA investment in her HSA before. She was just getting the interest that she was getting paid by Bank of America just to hold the money. You know what that interest was? It was 2 pennies 1 year. Okay, 1 penny another year. So for her to make $6,000 in just under 2 years was just completely out of this world for her, and she didn't have to pay a dime of taxes or penalties on it. Now, once the profit hits that account, what can you use it for? Let's talk about the details with the HSA, what makes it so fun. Before we talk about what you could pay for, let's talk about who qualifies for an HSA first. There's 3 qualifications in order to have a health savings account. One, you have to be enrolled in a high deductible health plan. I know they all seem like they're high deductible. Trust me. Call your health insurance provider if you're not sure and just ask them if your health insurance is HSA compatible. That's the easiest way to find out if you have a HDHP that allows you to have an HSA. Okay, so if you have the proper health insurance, that's check mark 1. And you cannot be on Medicare, and you also cannot be a dependent on someone else's tax return. So if you meet those criteria, bonus, you can have an HSA. Here's the real cool thing about HSAs when you make contributions, different than the ESA. Remember, the ESA, you don't get a tax deduction by putting money in. The HSA, you do get a tax deduction by putting money in. So it's actually the first account I contribute to every year because I get the tax deduction. Okay, so contributions are tax deductible, and the contribution deadline is also the same as the ESA, April 15th or whatever your tax filing deadline is. The contribution limits are based on who is covered by your insurance. If it's a single plan, that just means it's just you covered by your insurance. The contribution maximum is $3,600, and you have a $1,000 catch up at age 55. So if you're 55 and over, you can make $4,600 contribution, dollar for dollar tax deductible. If you're a family plan, it's you covered and somebody else covered, you and a child, you and a spouse, it's $7,200 with again, a $1,000 catch up at age 55, dollar for dollar tax deductible. The HSA is not a use it or lose it plan. Don't get this confused with the FSA. The FSA is a flexible spending account. You know, that flexible spending account, it's so flexible that they take the money away from you at the end of the year if you don't lose it, or don't use it. That is not this plan. The money in an HSA stays there and you can continue to reinvest it all the way into the day you die. They don't force you to take money out. You can pay for qualified out-of-pocket health expenses directly out of the HSA, or you can reimburse yourself for prior year's expenses, and it doesn't matter how far you go back. And what I mean by that is you can pay yourself back through an HSA distribution for things you paid out of your own pocket. The key to this, though, is any reimbursement you take from your HSA to pay yourself back has to be an expense you incurred when you had the HDHP in play and you had the HSA established. Okay, so that is key. You cannot set up an HSA and an HDHP today and pay for something 3 years ago when you didn't have the plan set up. So again, very, very important to get these plans set up and start getting some money in there. And even if you don't have, you want to keep enough money in there to invest. And that's why this is really key to understand this point, is that you don't have to nickel and dime your HSA to pay for little things here and there. Keep the money in there, keep it growing, keep it compounding on itself. And sometimes it's best to just pay yourself back later and just save all the receipts for whatever you pay medical related. And we'll get to what types of expenses you can pay yourself back for here in a second. Key deadlines with the HSA that you have to keep in mind. If you don't have an HSA, the deadline to set one up is December 1st if you intend to make a contribution for that year. So for example, if you want to make a contribution for 2021 and you do not have an HDHP set up, you have to have one set up before December 1st. If you go past December 1st, you could still set one up, but then you have to make a contribution for next year. You can't make a contribution for this year, okay? So very important to get it set up if you don't have one set up. And one other fun fact is you're allowed to fund your HSA with a tax-free transfer or tax-free rollover from a traditional Roth SEP or 401k. And you could do this once in your lifetime. Now, I already know what you evil rich people are thinking. How much money can I move from my traditional IRA to fund my HSA? It's up to your contribution limit. So it takes the place of your contribution. Okay. So if you have a family plan, that's $7,200. But think about that conceptually. If you have a traditional IRA that's got some money in it, and you have an HSA with no money in it, and you want to pay for a qualified education expense, if you take the distribution to pay for that expense out of your traditional, you pay taxes on it, and you got to pay a penalty if you're under 59.5. Instead, if it's for medical related expenses, you can just transfer up to the contribution limit, $7,200, transfer $7,200 from your traditional to your HSA. And when you take the distribution out of your HSA, it's tax-free and penalty-free. Now, you could do it out of a Roth. It doesn't make much sense in a Roth, though, because your Roth is already a tax-free bucket. It makes a lot more sense if you're taking it from a taxable bucket, like a traditional or a SEP or a pre-tax 401k, because anytime you take money out of that, you're going to have to pay taxes on it. So at some point in your life, if you haven't used it, you want to take some of that pre-taxed money and move it to a tax-free HSA if you have one set up and you have the HDHP. One time in your life, you can do that. Now, what are some of the things that you can pay for? Well, doctor's bills, hospital stays, prescription drugs, over-the-counter medications, menstrual products, alternative treatments, holistic medicine, travel for healthcare, dental and vision, and some insurance premiums. You usually can't pay for your insurance premiums if you're employed. If you ever go unemployed, the rules do change for you. You can take out money out of your HSA to pay for your health insurance premiums if you want to keep your health insurance going while you're in between jobs or if you're unemployed. So, and this goes way outside. This is just some of the expenses that can be paid. There's pages and pages of things that you can pay for as a qualified medical expense. So if we think back to Sarah's situation where she took $18,000 and basically turned it into $24,000 by buying a discounted note, she could take all of that profit and pay for a root canal, glasses, LASIK surgery, any other dental, vision. If she goes unemployed, she can continue her health insurance. These are all things that most people don't think about, or when they do think about it, they're paying those things with, again, HIP National. the money in their back pocket, they're taxable dollars. So if you could switch your mindset as an investor, and when you are finding investments, think, I really want to make some more, I want to make some money, but I want to consume more goods when it comes to education expenses and health expenses. Just use a different bucket. Use the HSA, use the ESA. Don't delay on setting these accounts up. The longer you delay in setting these accounts up, the more Uncle Sam says, please, yes, keep doing this with your own money because I like to have 30% of what you make. Okay, so very, very important to get these plans set up. And as I mentioned, especially with the HSA, there's a deadline to get this set up by December 1st. So make sure to contact one of my IRA specialists and get these set up for you guys before it gets too late. So now let's talk about the other plans that we're usually so laser focused on, that we should be laser focused on. But sometimes we even miss the boat on some of the investments when we're talking about our traditionals, Roth, SEPs, and Simples. Now, remember with these accounts, most of the benefit comes after we are 59 and a half. So even with the Roth IRA, even though it's an after-tax account, your earnings and your growth don't become completely tax-free in a Roth IRA until you meet two criteria. You've had the Roth IRA open for 5 years, and you're above the age of 59 and a half. Once you meet those criteria, your Roth IRA has now qualified distributions, and qualified distributions are tax-free and penalty-free for life. Your traditionals, your SEPs, and your Simples, they're always going to be taxed when you take money out, but they're also penalized when you take money out before 59 and a half. So on the investments that we saw earlier, right? Sarah's investment that paid off in less than 2 years, Jonathan's investment that paid off in 3 weeks. Could they have done that in these accounts? Sure, they could, but they can't reap the benefits tax-free until they're above the age of 59 and a half. So you can see where different investments fit different account types. And when you're also looking at these account types, don't pass on investments that pay off down the road. And this is why I wanted to bring this case study back, to life, because this is a great investment for people that want to put an investment on the shelf. And we've talked about this in previous case studies, and this would be buying property subject to. So what buying property subject to is, and a lot of real estate investors understand what this concept is it's really when you find a homeowner that's between a rock and a hard place. For example, in this particular case, a gentleman had owned a home and he lost his job. Okay, happens, and due to things like COVID, it happens a lot more than it has been in the past. So he couldn't pay his mortgage payments. Now, when you have a homeowner that cannot afford their mortgage, it's not the house that is the issue; it's the mortgage that's the issue. And what they're looking at is if they can't make up the mortgage payments, they're not only looking at foreclosure, but they're also looking at probably 7 years of bad credit. They're looking at a snowball effect of things that are going to just follow them for the next 7 years, and it just makes a bad problem even worse. In this case as well, there was really no equity in this property, so this homeowner was just between a rock and a hard place. Every investor that contacted him and found out what he owed on the property based on what the property was worth just kept passing on this deal because there was no equity in the property. Okay, he owed about what the property was worth. So again, and he doesn't have any money to make the mortgage payment. How is he going to come into closing with money to sell the property? So he was literally weeks away from being foreclosed on until our investor found him and started negotiating with him or trying to figure out the scenario. Now, here's the scenario with this property, is that this gentleman was about 5 to 7 years into the actual mortgage itself. Now, the reason why that's important, most investors know, is when you look at an amortization schedule, the deeper someone is into the loan, the more principal starts to get ticked away when you start making payments. So that was something that intrigued the investor as they're talking. But the investor wasn't interested in how much equity was in this property. He was more interested in, if I could rent this property out, do the rents of the area cover the mortgage? And this property was in a really good area, right off the freeway. Okay? And the rents in the area were about $13.50 a month. The PITI, or principal, interest, taxes, and insurance on the property, was only $9.50. Now, if you have, and this was a fixed rate mortgage, most mortgages you're going to run into nowadays are not those adjustable rate mortgages. You're going to run into a fixed rate mortgage. So this gentleman who owned the house, again, has a fixed rate mortgage at a really good interest rate. He just can't afford the payments because he's not working. And he knows, the investor knows, that $9.50 is going to stay relatively unchanged. The only thing that's going to really change in there is the taxes and insurance. but the rents are going to increase year after year. So he knew that going in as well. So what he went into is he went into a solution type situation to where he said, if I can offer this homeowner the ability to save their credit by me renting the property and even me giving them a couple $1,000s to walk, would this be the best situation or be the best solution for this homeowner in a situation where he didn't have much solutions? And the answer was yes. Okay, so the seller did agree to this, but in his mind, the investor, this wasn't an investment that was going to pay off today. This was an investment that was going to pay off in the future as he kept the property rented. The renter would pay, in this case, his Roth IRA, and the Roth IRA would make the mortgage payments on the underlying loan. So that's what buying property subject to is. It's buying property subject to the underlying financing that's already on the property. So the total investment that his Roth IRA had in this situation was $8,000. Okay, the $8,000, part of it, about $5,000, went to pay the past due mortgage payments, and there was about $3,000 left to pay the homeowner and give them a little bit of money to walk. Okay, so in that exchange, what the homeowner does is deeds the property to the Roth IRA. Now, again, he could have done this in his LLC, but this isn't an investment that's going to profit today. He's not looking at this investment like that. He's looking at this as an investment to just put on the shelf. So in exchange for $8,000, the mortgage is caught up and made current, and the property is deeded to the Roth IRA. Now, very, very important. If you're going to do this investment, do not do this investment with just $8,000 in there, because if you're going to make this type of arrangement, you need to make sure that there's enough money in the IRA to pay for any unforeseen repairs, any vacancies. So have some sort of a buffer in the account in the event that that happens. Okay, there was about 1 month of vacancy while they transitioned the existing homeowner out and actually get it rented. So there was 1 month that the Roth IRA had to pay the mortgage payment, which was just $950, and then they were able to get the property rented. Okay. It rented immediately for $1,300, a long-term lease. Okay, and the investment continued to generate rents month after month. Here's how this works logistically. Okay, as the renter pays the property manager can pay the mortgage payment. The property manager can pay, whatever expenses need to get paid, and the property manager can take whatever's left and send back to the IRA. We don't care as NuView how you do it. Just make sure you're not taking the money personally and depositing it into your own account. So either the money has to come directly from the renter to NuView, and then NuView can make the mortgage payments and any expenses, or you can use a third party. Property managers are often great as that third party. So fast forward in time, rents continue to go up, as he holds this property. And think about this 15 years into the future. Well, 15 years into the future, you're getting down to where this note is pretty much paid off. Okay, thank you, renter. Okay, in exchange for the Roth IRA making only initial investment of about $8,000 to $10,000. But again, this is an investment to put on the shelf. And what this investor's plan was to do is to have this house paid off in, say, 15, 20 years, but that house that was worth about $150,000 back when he took title to it, in 20 years is going to be worth $300,000, maybe $350,000, but it should be owned free and clear and owned by his Roth IRA, making that $8,000 investment to $350,000 all completely tax-free. But again, why is this right place, right time, right deal? Because this is an investment that pays off in the future. And there was about a dozen investors that passed on this deal because they're just thinking about, how can I make money today? How can I make money today? How can I make money today? This is a perfect example of why you use your IRA to make money tomorrow. Okay. So want to go over some cautions though with this. Okay. And you real estate investors understand this, but make sure you understand before you do anything subject to, talk to an attorney that specializes in setting up these types of deals. Okay. There's attorneys that specialize in making sure that you've got all your T's crossed and your I's dotted when it comes to taking title to a property that has existing financing on it. Make sure you understand the due on sale clause. Okay, most notes and mortgages have a due on sale clause, meaning if there's any transfer of ownership, any transfer of title, that bank has the authority to ask for all the principal and interest due at the time of sale, at the time of transfer sale. Now, will they most likely do that with no equity in the property? No. Will they most likely do that if the payments become current? No. I will tell you, I've seen these deals done many, many times, and you still have to be aware of the due on sale clause, but banks are not in the business to own property. They just want the payments. If the payments become due or the payments become current and the payments continue to come in, most banks won't even bat an eye. Okay. What happens if they do call the due on sale clause? Okay. Have some sort of backup so that you can either buy the property or refinance the property. Now, I will tell you in this case, what he ended up doing, sorry, not this case, another case where a client bought a property subject to, the bank came calling 5 years later after they transferred title. Since the IRA had had record of making the payments for more than a year, what they ended up doing when the underlying loan was called due, they just refinanced the loan to a non-recourse IRA lender. Done, out of the picture. Okay, but just be aware, you need to be aware and need to be cautious of the due on sale clause, just in the event that the bank does call the loan due. The underlying loan, but a lot of get this question. Well, doesn't the loan have to be non-recourse if it's an IRA owning the property? Yes, it does have to be non-recourse. But what does non-recourse mean? Non-recourse means that the loan tied to the property can't be recourse to you personally, the IRA owner, and it can't be recourse to the IRA. It is non-recourse. Okay, it's recourse, but it's recourse to who? The original borrower. So you got to keep that in mind, because you need to make sure that you honor that agreement and make sure that that loan stays current, because it's still going to be tied to that borrower, but based on the non-recourse language, but inherently it is non-recourse because it's not recourse to you or the IRA. I mentioned this earlier, make sure you have enough capital in your IRA to cover any unexpected repairs or vacancy. And this will be considered a debt leveraged investment. So you do have to factor in any unrelated debt finance income tax, but remember how the unrelated debt finance income tax works. When it comes to your two income sources, the rents and capital gains when you sell the property, but the rents are only going to be factored in the percentage that your IRA is debt leveraged, but it's only based on net income. Okay, if you've got income coming in through the rents, but then it's going right back out to pay the mortgage payment, your net income is not very much. But then you also, since your IRA is now a taxpayer, you get to use depreciation and expenses to whittle that net income even down even further. So situations that I've seen where this triggers UDFI to the IRA, the UDFI is so small, it doesn't even do anything that the IRA owner is concerned about. And then when you talk about the capital gains aspect of it, here's how the capital gains works when they're factoring in a debt leveraged investment and they're looking at the IRA as a taxpayer. When it comes to your UDFI, when it comes to capital gains, at the time of sale, they're not going to go back and say, what did this IRA acquire this property at? What was the debt leverage percentage back 10 years ago? That's not what they're going to look at. They're going to go from the time of sale and they're going to go back 12 months. They're going to look at what's the average indebtedness for each one of those months. And that's going to be your debt leverage percentage. So let me just say, in a perfect world, here's how you can get by doing this investment scenario with paying no capital gains tax. If you own the property all the way until the loan is paid off, and then you own the property another 12 months past that date, your average indebtedness, if you were to sell the property 12 months after the note's paid off, is zero. Your capital gains tax is zero. So it's as if you bought the property cash with no debt. You just have to make sure the debt gets paid off. And even if you hold it long-term and there's a small amount of debt left, again, your UDFI is only going to be based on the percent that your debt leveraged. So UDFI is going to sting you if you try to flip a property after you take it subject to, but if you buy it long-term, throw it on the shelf, which is best in an IRA anyways, you could still get by with paying no capital gains tax whatsoever. So very, very key component to that. I think that's it on that one. So again, right place, right time, right deal. Alex, we got any questions? No questions. Great. You guys are all experts. I appreciate you guys listening very intently. So just a little joke. If you guys do have questions, we laughing at Grace. If you guys do have questions, here's what I want you guys to do. Any questions, doesn't have to do with this case study or anything else. Email IRA specialists, that's with an S, IRA specialist at NuViewTrust.com. I'll have the email here in a second. But before I get to that, what I want to do is I want to remind everybody that we do have a bonus workshop that we're going to be doing tomorrow. Okay. The reason we're doing this bonus workshop, and a lot of you know this, is we've got some tax changes that are coming down the pipe based on the current administration and their Build Back Better agenda. So the Build Back Better agenda is the administration's plan to increase spending and increase taxation for the next 10 years. Again, this is not a political opinion at all, but there is some mention as to how they want to change retirement accounts. Okay. And these changes are coming through what's called the Ways and Means Committee. Okay, who are the chief tax writing authority for the administration, and they've got a lot of changes that they want to make to IRAs and specifically self-directed IRAs. It's important that you watch this workshop, because if the law passes as is, there's going to be a lot of different things coming down the road, and a lot of it is not good for self-directed IRA investors and just IRA investors in general. So we're going to talk about the Ways and Means Committee's tax proposal when it comes to retirement accounts, and specifically self-directed retirement accounts. And that's going to be tomorrow at noon. So not 1, but tomorrow at noon Eastern time. If you miss it, don't worry. It'll be recorded on our Facebook page and posted on our YouTube channel. But if you want to register, scan that QR code there and register for that, or just join us in tomorrow for that bonus workshop. If you're in the area of Florida, Central Florida, we are hosting our next Night with NuView event October 27th at the venue on the lake in Maitland. We've got a very special guest speaker, Rod Khalif, who's got the #1 commercial real estate podcast on iTunes. He's a great motivational speaker, and he's a great knowledgeable investor, especially when it comes to multifamily investing. He's going to be speaking at our event, and the event's completely free. There's going to be food, there's going to be beverages. We're going to have a real good time. So make sure that you guys come attend that event October 27th from 6:30 to 9:30 in Maitland at the venue on the lake. Also, you can scan that QR code to register for that event. And again, it's completely free, guys. And we are looking for some additional sponsors. If you want to sponsor the event, have a booth, also email IRA specialist at NuViewTrust.com. And here's that email address there. That's B Martinez. Sorry, wrong email address. You can send it to B Martinez. He's one of our IRA specialists, but just use IRA specialist at NuViewTrust.com. We're also giving everybody a promo code to use for the next few days. If you want to open your own HSA, Roth, ESA, even 401k, we're waiving the application costs from now until the end of the month. And we're also giving you a $50 credit towards future fees. So make sure to email us at IRA specialist at NuViewTrust.com. If you want to take part of that promo, just say, I want my 50/50 promo. And again, IRA specialist at NuViewTrust.com. That offer expires in 2 days. So I hope this was beneficial to you guys. If you want to watch the replay for you registering, you'll get the replay in about a week. But if you want to watch it right away, just go to our Facebook page. Make sure to follow us on Facebook and make sure to subscribe to our YouTube channel so you get notifications of when we post these things live. So sorry, one question? No? All right. Very beneficial. Thank you, guys. I appreciate you guys. We'll see you tomorrow on our bonus workshop. Have a great day, everybody.